FANG stocks move into a state of weakness as institutional investors are now assessing their portfolios, moving money around and finding safer bets. The market has looked very worried about the recent declines, and this will definitely be a huge problem if interest rates continue to rise as the Fed suggests. You came here for the truth, so let me unveil that for you. Today we are going to look at the FANG stocks. We're going to show you this today and really highlight what has happened, the result of this, where we're leading up to into this moment. All right, so the market has closed. I'm going to show you a few stocks. I'm going to show you several charts, in fact, a couple articles in there as well. So one of the FANG Plus stocks is Twitter. We saw that coming down on Friday's trading session. Now this is Monday's trading session. Another 8% decline. This stock has moved down to $31 approximately. If you look at where it has come from, of course, we are still up, but in general, this stock and the ones I will show you next have all come down. Now, Facebook, we saw that coming down previous to this on Thursday, I believe it was, a 20% drop. Now today on Monday's trading session, down about 2%. Netflix is down 5.7% as of market close, and the VIX is still so calm. We are sitting right now at 14, although it should be twice as high. It doesn't really matter. Nobody cares. Anyway, they just invest into FANG stocks. A closely watched stock index of global technology giants tumbled toward correction territory on Monday, showing the fragility of investors' bets on the popular FANG group of stocks. So it lists how they've all gone down here in this case. In the afternoon trading, the index was down 2.7% and on course to close 10% below its June 20th record. If the index holds its losses, it will have entered correction territory for the second time this year. So this has been a significant drop here after having a really long and strong run-up. The FANG stocks have soared past the S&P 500 this year as investors bet on technology up, ending the ways people shop, communicate, and entertain themselves. But over the last month, a number of FANG stocks, as well as some other tech companies, such as Twitter, have tumbled following disappointment earnings and cautious outlooks about future growth. It's going into other issues in this article, but I just wanted to show you this about Netflix. Their shares were down more than 4% on Monday morning. At session lows, they were down 20% from their June highs, making it a bear market. This is one stock that had come up so considerably. And everybody was saying, Netflix is going to be the next best thing. It's going to be so wonderful because of everything that has happened. They have been winning awards. They've been doing a lot of smart moves. And therefore, we should dump all our money into this stock. Well, you can't just have one or two factors be the reason why a stock goes this crazy. Now, this is the type of stock that people sell first when times get tough. They don't hang on to them as you would consider maybe some staples around that would be something that people would buy and hold, right? So Netflix might be one of those that individuals in the institutional side would sell off in this time. They take their profits. They made, let's say, 50%, 100% profits. They see the stock is starting to weaken. They just sell it off. They take those profits and they give them to their investors. And that's the way this works. They are trying to make money and they do so intelligently. And that is, you see the profit, take your losses, and put your money in somewhere where it can be more safe. That's debatable. But anyway, it goes into more details about Netflix, but I just move on to a couple of charts here. The FANG stocks, you can see this here going below this trend line. And in fact, although it is only, if you look at it percentage-wise, we're still around the levels experienced in June, it's really come up quite a bit since then. So it is a significant drop, but we're only moving back into June's territory. I'm not going to deny that, but it is still very important to see these coming down 10% as a whole. Some of these stocks moving down 20%. The market cap dropped by $218 billion, and I'm not even sure if that was at the absolute end of the day, but we'll just round it off to that. Let's just say a little bit over 200 billion. FANG stocks market cap coming down significantly in this time period. A lot of money has been washed away. Since our upgrade of utilities on June 18th, the S&P 500 leadership has turned decidedly defensive. Things have really changed in just a short period of time. I mean, look at tech. This is always at the very top, the most invested in this case, and I've shown you some of those before, and I will continue to when I get an updated chart of that. But you could see really utilities and staples are at the top of this list right now. Very different to see that compared to, let's say, a couple months ago. Things have really changed. All right, now one other very important indicator is breadth. Now you can take this how you want, and there's different ways to look at it, but the way I do and the way I think everybody should just look at this is very simply, what are people buying? What are people selling at this time? All right, you can see that we have very few stocks that are rising, and that's never a good thing. We can look at this indicator to tell us the health of the economy. And this really shows us going back into the territory that we experienced in 2008. Too few stocks moving up, the rest of the stocks moving down, they're selling off, and that essentially means that more and more money is funneling into this more of a narrow band that's always dangerous, and it spells disaster. When you have 20% drops in some of the biggest stocks in the world, that is never ever a good sign. This right here is the NASDAQ actually dropping below its 50-day moving average. Very serious indicator for those interested in the technicals. And last but not least, the most important of all, when we see the G3 central bank balance sheet, or the G4, G5 plus one, there's so many different ones. When we see the central banks around the world decreasing the amount of money that they hold on their balance sheets, they're buying up the toxic garbage, they're not printing as much, that's for sure. However, if we just see them selling off or letting that, depending on what it is, letting it expire, then of course we are going to see stocks follow. This has been the trend. Definitely the NASDAQ, or more particularly the FANG Plus stocks, have been the leaders. They've been the last few stocks to really rise, and more money has been flooding in as money has been leaving a lot of other stocks, a lot of other types of investments. But now we can see that over the last couple months, the balance sheets of the G3 have peaked out. Once peaked out, that starts to create all this turmoil. I mean, it's never a good thing when the market has been supported by QE that the QE goes away, or slowly anyway. But that's going to be a big problem for the entire world, because they're all going to be affected by this, okay? So let's keep our eyes on the central bank balance sheets. I think is very key, as well as interest rates. Those are my two primary indicators for the inevitable collapse that we will experience. If you found this video informative, please give me a thumbs up. And if you want the financial education that you were not taught in schools, intentionally kept from you, then these two books have it all. In these two easy to read books, you're going to learn everything from A to Z, from the foundation and the history to the asset classes, how to make money, reduce debt, and so on. You can actually look through these books. The link is in the description. You can go over there. It's going to show you on Amazon. You can actually flip through the pages. And if you're more interested in the audiobook version, you can get that at themoneygps.com.